People entering retirement today face a financial environment that is fundamentally different from previous generations. Inflation has steadily reduced the real value of wages, pensions, and savings, meaning that a dollar earned or saved today buys less than it did even a decade ago. While official inflation measures, such as the Consumer Price Index, track overall price changes, many essential costs rise faster than reported averages. Housing expenses, including rent, mortgages, property taxes, and maintenance, have increased significantly, especially in urban and high-demand areas. Healthcare costs, including insurance premiums, medications, and out-of-pocket services, rise at rates exceeding general inflation, placing additional strain on fixed or limited income sources. Utilities, energy, and food prices are also trending higher, often unpredictably, and retirees relying on Social Security or minimal savings find their purchasing power diminished. Interest rates add complexity to this environment. Higher rates can benefit those with substantial balances in savings accounts, CDs, or bonds by generating higher returns, but they do little for individuals with no capital to deploy. For those without savings, rising interest rates translate into higher borrowing costs for credit cards, personal loans, or home equity lines, reducing disposable income and creating vulnerabilities to unexpected expenses. This dynamic makes even small financial shocks, such as emergency medical bills, car repairs, or household maintenance, more difficult to manage and can quickly escalate into long-term financial strain. Government debt compounds these pressures indirectly. High federal debt limits fiscal flexibility and increases the likelihood of policy changes, such as tax adjustments or modifications to Social Security and Medicare programs. While these changes tend to occur gradually, they cumulatively affect retirees who have no financial buffer, as they absorb the full impact through reduced purchasing power or higher required contributions. Currency devaluation further erodes income, particularly for those who depend on imported goods, medical supplies, or fuel, because the cost of these items rises when the dollar's value declines. Retirement and post-retirement risks intensify when savings are absent. Health declines, caregiving responsibilities, and reduced work capacity become more likely with age, and without financial reserves, there is no margin for error. The focus shifts from wealth accumulation to income replacement, stability and predictability, with the primary goal being the ability to cover essential expenses month after month. Social Security and other guaranteed benefits form the baseline, but adjustments often lag behind actual cost increases, leaving gaps that may require additional income sources, borrowing, or reliance on family support. These combined forces: rising living costs, interest rate pressures, limited purchasing power, government debt constraints, and currency devaluation create a structural financial problem. It is not simply a matter of having saved too little, but of facing an economic environment where earning, saving, and spending are increasingly constrained. Understanding this reality is critical for anyone approaching retirement without a financial cushion, because it frames the problem as one of maintaining reliable cash flow rather than pursuing growth, highlighting the need for stability-focused strategies that prioritize covering essential needs in an uncertain and inflationary economy. Traditional financial advice often fails older adults because it is built on assumptions that no longer apply in late-stage retirement planning. Many recommendations assume decades of work remain, time for markets to recover from losses, and the ability to tolerate short-term volatility in exchange for long-term gains. For someone entering their 60s or 70s with limited or no savings, these assumptions break down. Aggressive investment strategies designed to catch up can expose retirees to significant market risk at a point when recovery is unlikely. Sequence of returns risk becomes critical because early losses can permanently reduce income potential, particularly if withdrawals are required during market downturns. Without a financial buffer, even a single adverse market cycle can create long-term shortfalls that cannot be made up later. Advice to extend working years may appear logical, but it is not universally practical. Health limitations, caregiving responsibilities, physically demanding jobs, and age discrimination reduce the ability to work consistently. Earnings may be inconsistent, lower than expected, or insufficient to meaningfully alter long-term financial security. Planning frameworks that rely on uninterrupted employment ignore these real-world constraints and can create a false sense of confidence for those without savings. Recommendations to cut discretionary spending often fall short as well, because older adults with no financial cushion typically already operate on limited budgets. Most expenses are fixed or essential, such as housing, utilities, insurance, food, and healthcare, leaving little room for meaningful reductions. Extreme frugality may reduce quality of life without materially improving financial stability. And focusing solely on spending cuts can divert attention from more impactful actions, such as optimizing guaranteed income sources or managing risk exposure. Some advice assumes access to sophisticated financial products, professional investment management, or complex strategies. These options often involve fees, minimum balances, or complexity that make them impractical for individuals with limited resources. Complexity itself becomes a risk because misunderstandings, errors, or inappropriate products can worsen financial outcomes. Guidance that emphasizes average market returns or historical performance may also mislead. While long-term averages appear favorable, individual outcomes depend heavily on timing, withdrawals, and personal circumstances. Over-reliance on optimistic projections can result in underestimating risk and overestimating income, leaving retirees exposed when real expenses rise faster than anticipated. The failure of common financial advice stems from treating late-stage retirement planning as a continuation of early-stage accumulation. Goals, constraints, and risk tolerance are fundamentally different when income replacement, predictability, and stability matter more than growth potential. For older adults with little or no savings, effective strategies must replace accumulation-focused guidance with approaches centered on maintaining predictable cash flow, minimizing exposure to losses, aligning expenses with guaranteed income sources, and preserving capital because the primary objective is not wealth creation but financial survival and continuity under economic uncertainty. Common retirement advice often fails older adults with little or no savings because it assumes circumstances that do not reflect the realities of late-stage retirement planning. Much guidance is designed for individuals with decades of work ahead, the ability to recover from market volatility, and the capacity to tolerate short-term losses for long-term gains. For someone entering their 60s or 70s with limited capital, declining earning capacity, and higher exposure to health risks, these assumptions no longer hold. Strategies built around accumulation or aggressive investing may create more risk than benefit, particularly when the objective is replacing income rather than growing wealth. One common recommendation is to invest aggressively to catch up financially. While this may seem logical, it significantly increases exposure to market swings at a time when recovery is less likely. Sequence of returns risk becomes critical because early losses during retirement can permanently reduce income potential, especially if withdrawals are necessary for living expenses. Without reserves, retirees cannot wait out downturns, making aggressive strategies dangerous rather than helpful. Another frequently suggested approach is to continue working longer to increase savings or delay claiming Social Security. While extended work can provide additional income, it is not a viable solution for everyone. Health limitations, caregiving responsibilities, age discrimination, and physically demanding jobs reduce the feasibility of sustained employment. Even when work is possible, income may be inconsistent, insufficient, or unpredictable, and planning that depends on continuous employment can create unrealistic expectations. Advice that emphasizes cutting discretionary spending also has limitations. Older adults without savings often already operate on tight budgets, and most expenses are fixed or essential, including housing, utilities, healthcare, insurance, and food. Extreme frugality may reduce quality of life without materially improving long-term financial stability. Focusing solely on spending reductions can distract from more impactful decisions, such as optimizing guaranteed income sources, managing debt, or controlling exposure to market risk. Some guidance assumes access to sophisticated financial products, professional investment management, or complex strategies. These solutions may involve high fees, minimum account balances, or structures that are impractical for individuals with limited resources. Complexity itself introduces risk, increasing the likelihood of mistakes, misunderstandings, or unsuitable investments. There is also a tendency to over-rely on average market returns or historical norms. While long-term averages may appear favorable, real outcomes depend on timing, withdrawals, and personal circumstances. Optimistic projections can lead to underestimating risk and overestimating future income. The core failure of common advice lies in treating late-stage retirement planning as a smaller-scale version of early-stage accumulation. Goals, risk tolerance, and constraints are fundamentally different. In this context, protecting income, avoiding large losses, and ensuring access to essential services take precedence over maximizing returns. Effective planning replaces generalized advice with strategies grounded in realism, simplicity, and control, emphasizing predictable cash flow, risk management, and the ability to cover essential expenses consistently. A workable retirement approach for someone in their 60s with limited or no savings must shift focus from wealth growth to income reliability, expense control, and risk reduction. At this stage, the goal is not accumulating assets but creating a financial structure that can function effectively under uncertain economic conditions. The first step is to identify dependable income sources and understand how they align with essential expenses. Social Security often forms the foundation of monthly cash flow, and decisions regarding when to claim benefits have long-term consequences. Delaying benefits can increase lifetime payments, while early claiming reduces monthly income permanently. The choice should be evaluated based on health, employment prospects, and immediate financial needs rather than generalized guidance. Expense management is equally important. Fixed costs such as housing, utilities, insurance, and healthcare must be aligned with predictable income streams. High-interest debt should be reduced or restructured to lower ongoing obligations and increase financial flexibility. Eliminating unnecessary commitments reduces the risk of forced borrowing in emergencies. The focus is not extreme frugality but predictability, ensuring that limited income stretches further and remains resilient against inflation shocks. Guaranteed or stable income sources provide an additional layer of protection. Pensions, annuities, and government benefits deliver regular payments regardless of market conditions, addressing the primary risk faced by retirees without savings, which is interruptions in income. Predictable payments simplify budgeting and reduce reliance on credit. Stability is more valuable than potential upside when resources are constrained. Risk avoidance is central to this strategy. Large financial losses are far more damaging than missed gains, so speculative investments, high-fee products, and complex strategies should be avoided. Liquidity matters more than return because access to cash during emergencies prevents small disruptions from becoming long-term financial problems. Even modest reserves can provide meaningful protection if they are accessible and preserved. Healthcare and insurance planning play a major role as well. Medical expenses are a leading cause of financial stress in retirement, and understanding Medicare options, supplemental coverage, and potential out-of-pocket costs helps prevent sudden financial shocks. Insurance decisions should prioritize catastrophic protection rather than comprehensive coverage that strains monthly income. Work, when feasible, becomes a supporting tool rather than a primary solution. Part-time or flexible employment can supplement income, delay benefit claims, and provide additional financial margin without relying on full-time work. The emphasis should be on sustainability and adaptability, recognizing that work capacity may decline over time. A functional retirement system integrates these elements into a simple, maintainable structure. Clearly defined income sources, controlled expenses, minimal debt, and limited exposure to risk create a foundation that prioritizes continuity over growth. This approach does not promise comfort or abundance but reduces uncertainty, improves predictability, and increases the likelihood that essential needs will be consistently met over time, providing a stable framework for late-stage retirement planning even without substantial savings. Long-term survival in retirement without savings depends on a system that emphasizes cash flow stability, controlled risk, and regular reassessment rather than asset growth or complex financial strategies. The objective is to ensure that essential expenses can be met consistently under a wide range of economic conditions. The foundation of such a system is a clear understanding of guaranteed income sources and their reliability over time. Social Security, pensions, and any contractual income streams form the core of this framework. Mapping these sources against fixed monthly expenses allows retirees to identify gaps, vulnerabilities, and areas where additional support may be required. Cash flow management is central to the approach. Income must arrive predictably and be sufficient to cover housing, food, utilities, insurance, and healthcare. Irregular or uncertain income increases reliance on credit, exposing retirees to interest rate risk and compounding financial vulnerability. Where possible, income streams should be structured to align with recurring expenses, reducing timing mismatches and easing budgeting pressures. Risk management focuses on preventing large losses rather than pursuing returns. Avoiding leverage, minimizing exposure to market volatility, and maintaining access to liquid funds are critical priorities. Even modest cash reserves act as a buffer against unexpected expenses such as medical bills, home repairs, or other emergencies, preventing temporary setbacks from becoming long-term financial crises. Preservation of capital, however limited, takes precedence over potential gains because the consequences of loss are amplified for individuals with no savings. Periodic reassessment is a vital component of long-term sustainability. Economic conditions, changes in benefit programs, healthcare needs, and personal capacity evolve over time, making static plans ineffective. Regular reviews allow adjustments to income timing, expense management, and risk exposure before problems escalate. These check-ins do not require complex analysis, only consistent attention to core variables that affect stability and continuity. Simplicity enhances durability. Complex investment products, frequent trading, or intricate withdrawal strategies increase the risk of errors and dependence on external advice. A straightforward system is easier to understand, maintain, and adjust under stress, especially as cognitive and health factors become more relevant with age. Expense alignment must remain ongoing. Inflation, healthcare costs, and utility increases typically outpace general income growth. Monitoring essential expense categories helps identify areas where costs can be contained without compromising basic needs. The objective is balance rather than continual reduction. This system is not designed to recreate pre-retirement living standards or achieve full financial independence. Its purpose is to maximize reliability, reduce vulnerability, and maintain control over resources. By emphasizing predictable income-controlled risk liquidity simplicity and regular review, older adults without savings can improve financial continuity, minimize exposure to economic shocks, and maintain the ability to cover essential needs, consistently creating a sustainable framework for survival in retirement regardless of the absence of substantial financial reserves. Right now, people's money is under pressure from multiple economic forces. Inflation has steadily reduced the purchasing power of wages and savings. Essential expenses, housing, healthcare, insurance, utilities, and food have risen faster than the official inflation rate. Interest rates have increased, benefiting those with substantial savings but making credit and borrowing more expensive for those without. Social Security adjustments lag behind real-world cost increases, and high government debt creates the potential for future tax changes or benefit reductions. Currency devaluation further erodes real income, especially for retirees relying on fixed dollars. Combined, these factors expose older adults to a higher risk of income instability and financial stress during retirement. Common financial advice often fails in this environment because it assumes decades of time to accumulate wealth, tolerable exposure to market volatility, or access to sophisticated financial instruments. Recommendations to save aggressively or invest for growth are less effective for someone approaching or in retirement. Strategies like delaying retirement income, taking on leverage, or expecting high market returns may increase risk without improving financial security. Expense-cutting advice is often insufficient because essential costs cannot be reduced meaningfully. Planning frameworks that worked for earlier life stages do not directly translate to situations where income replacement and risk management are primary objectives. What works is a structured approach based on the principle of the bulk and cut strategy. The bulk phase focuses on accumulating and protecting resources while maintaining essential income, while the cut phase emphasizes controlled spending, predictable cash flow, and risk avoidance. In practical terms, this means identifying reliable income sources such as Social Security, pensions, or annuities, mapping them against fixed monthly expenses, and creating buffers for healthcare, housing, and emergency needs. Debt should be minimized or managed to reduce interest costs. Investments should prioritize stability and liquidity over growth, preserving capital and ensuring access to cash when needed. Periodic reassessment ensures that income, expenses, and risk exposure remain aligned as economic conditions, health, or government policy change. A practical step-by-step outline includes: list all guaranteed income sources and timing, identify essential expenses and align them with predictable income, reduce high-interest debt and unnecessary financial obligations. Establish a cash reserve for emergencies, evaluate insurance and healthcare coverage for catastrophic protection, limit exposure to market volatility and complex financial products. Monitor economic indicators such as inflation and interest rates periodically. Adjust spending, benefits timing, and risk exposure as conditions change. Prioritize income stability over potential growth. Maintain a simple, understandable financial structure for long-term continuity. Disclaimer: this content is for educational purposes only and is not financial advice. Readers should consult a licensed financial professional before making retirement or investment decisions.